is liquidity? Liquidity measures whether a business has enough cash or assets that can quickly be converted into cash to meet its short-term financial obligations. We are going to look at the two liquidity ratios, current ratio and asset test ratio. Current ratio, its formula is current assets divided by current liabilities. So we are going to typically need information from a statement of financial position, also known as a balance sheet, in order to calculate these ratios. We are going to need the current assets section from the statement of financial position. Typically, we will find current assets such as inventory and trade receivables and cash, to mention a few. Now, what are current assets? These are assets a business expects to convert into cash, sell, or use up within the next 12 months, such as cash, inventory, and trade receivables. So let's have a look at a list of current assets. We have cash, bank, inventory or stock, trade receivables, also known as debtors, people who owe the business money, and prepaid expenses, expenses that we've paid in advance. We are also going to need the current liabilities section from the statement of financial position. Here we will typically find current liabilities such as trade payables and accrued expenses, to mention a few. What are current liabilities? They are debts and financial obligations that a business must pay within the next 12 months, such as trade payables, overdrafts, and short-term loans. Let's run through a list of current liabilities. Trade payables, also known as creditors, bank overdraft, accrued expenses, expenses that we are behind in paying, and short-term loans. Question time! Calculate the current ratio, and this is for 2 marks. They give us the financial information we are going to need, our current assets, inventory, and current liabilities. We are going to need the current assets, and this is 14,000. We are also going to need the current liabilities of 8,000. Here is our formula for current ratio again. Let's plug in the values. So we have 14,000 as our current assets, and 8,000 as our current liabilities. 14,000 divided by 8,000 gives us 1.75 to 1. This is a ratio. Now, a good current ratio is between 1.5 and 2. So this is a good ratio, right? Because it's 1.75. It's between 1.5 and 2. Now, with liquidity ratios, there's a problem of having too little cash. That makes sense, right? Because we can't pay our debts. But there's also the problem of too much cash. A good ratio is between 1.5 and 2. If it goes beyond 2, we have a problem of too much cash because our money is not making more money babies for us.